Okay, good afternoon, everybody. Again, this is Jim Kenny for the weekly market update for optionprofessor.com. And this is for the week that ended on July 26, 2019. As always, I do remind you that past performance is not necessarily indicative of future results, and also that short term trading, option trading involves substantial risk of loss. Not right for everybody. Ask your advisor, ask your clearing firm, and your good common sense before you entertain any ideas on any type of investment. Okay, I did want to get into a lot of things here today. Again, quick background on myself for new listeners. I'm Jim Kenny, graduate of Boston College, been in the investment arena here for decades, have given hundreds upon hundreds of seminars on options, uh, the uses and the risks, as far as limited risk speculation, as far as cash flow, and also as hedging, using options as a hedge against market declines, or to protect against a run up using options to use as replacement trades. So, any questions you have on that type of thing, because this is a short broadcast, do email me at optionprofessor@gmail.com and include any questions you have, and I'll be able to try to help you with those. Okay. Right now, let's take a look. And a lot of things happened this week, and a lot of things are going to be happening next week. It's a pretty active period. We had the markets, as you can see, close up 51 on the Dow, up 91 on the NASDAQ, came down a little bit at the end of the day. We've had a good size run up this week. The earnings are coming in generally better than expected, and the GDP came out at 2.1 for Q2. That was better than expected. And the consumer spending and consumer participation numbers in the GDP report were quite good. Consumer consumption up 4.3%. I think the wages are up over 3%, and the inflation, which was at 1.1%, is up to 1.8%. So the Fed has a decision to make next Wednesday, and it is probably going to cut a quarter of a point, but it may not be quite as dovish in its talk. We really have two worlds going out there: the consumer world, which is going great, and the industrial world, which is not going quite as well. China is having some disputes with FedEx, and there's some saber rattling on what might happen there. So there is some uncertainty going on in the area of the industrials. Okay. Again, Fed expected to drop rates next week a quarter of a point. We had a lot of earnings out this week. Google, big day Friday. Let's take a look at it real quick. And it's up 118, down in the aftermarket. Big move up to 1250. 52-week high is 1289. Let's take a look at the all-time high, because I think it might be in the 1300s, but let me just double check here and see if I can find that for you. Okay. Yeah. So with regards to other stocks that came out this week, we have Amazon, which was up near its 2000 area. That's where the resistance is, 2050. Rolled over pretty much at the on the news. I guess the growth of their web services was not quite as good as people thought. So Amazon on Friday, as I'll show you right here, was down about $30. Other things that came out, Intel was another one that started up and then came back down. And then you have got a couple of companies that their same-store growth looks very good, and that would be Starbucks and McDonald's. McDonald's didn't do too much, but Starbucks had a pretty big day. I'll show that to you right now. And yeah, Starbucks up almost 9%. So that's a pretty good move. All-time highs, I believe, at 99.72. So, mixed bag, but a lot of them did do a little bit better than people thought, and on balance seem to be doing pretty good. These chip stocks seem to be on their horse again. I'll show you right now here on SMH exactly how they're doing. They were down a little bit, went up to 122, but look at the run they've been on. The run they've been on is quite strong. There you go. boom from boom. So, 100 up to 125, 25% jump in the last month or so. So a couple of months. So that's a pretty good size move. What I'd like to do here is go over what my views are on the market. These are my opinions, my views, and I'm sharing them with you. With regards to the S&P, I'll give you a little background as I always do, and I'll tell you what I think is happening right now. Okay, S&P right in front of you there. There you go. It was down in December, about 7 months ago, to about 2350. At that point, I thought it could snap back to its 200-day moving average, which was around 2750, which it did, and it did it pretty fast. Within what, 6 weeks? So after it hit the 2750, we started bouncing between 2800 and 2700. If we broke above the 2800, the likelihood of going up to the high of 2950 was very high, which is exactly what it did. Got a short-term scare in May, down at 2722. And now we're back on the bicycle up into the 3,000 area. When we were down here and moving up to 2,800, my view was that the market may go into a sell zone of 2,950 on the bottom end and 3,100 on the top end. I still believe that's happening. But you don't step in front of a train. You don't fight the tape. You don't fight the Fed. And there's no formation of any type of a rollover at this point. So my point is that this area between here and 3,100, you'd be looking for a weekly high surrounded by lower weekly highs to give an indication that it could be exhausting. And also the number 2,950, a close under there with a VIX above 17 would indicate to me that a 5 or 10% correction may very well be in the cards. So what I would like to show you where I'm getting that 2,950 from. And again, it's always, in my view, best to let the market dictate what you're looking at. And I'll show you right now on this graph why I'm looking at the 2,950 area, because this is a 6-month graph, shorter term. And there you go. Can you see that was a former high point? That should be support. Can you see there's a little gap in there? And then you can see, so that area, and this was the former high, right? So I'm looking for 2,950 to be support on any pullback. If you break under there, then it opens the door for all this stuff down here, in my view. So what do you do right now? I think you hold tight and see if a weekly high is made and then surrounded by lower weekly highs. So this weekly high is obviously the all-time high of 3027.98. And with regards to next week, if we don't take out that number, which we probably will because you'll get some jolt maybe out of the Fed situation, then the following week, which would be the second Friday of August, then you could be looking at a situation where a formation would be there that might show a little exhaustion. But right now, it's making new highs. You can't fight the tape. Yes, 2,950 if it closed underneath there. Yes, if that VIX can get above 15. Let me show you the VIX so you can understand where I'm getting that number from. 15, 17. Above those numbers, it would be indicating that the market might be increasing in volatility. Let me show you here. Okay, can you see here? This is the area of around 15. In fact, I'm going to go back to the yearly graph, 1-year graph, and that is a little bit clearer that 15 is a pretty important point. Yep, you see 15, 15, okay? You get above 15, and that little area here, 17, and then you can start making a run at 20, and if you get above 20, you make a run at 25, and then you got a real big correction coming up. But no evidence of that yet, but you always got to look at where the puck's going, right? You can't just look at where the puck is right now. Right now, though, it's a hold pattern because the market's in pretty good shape, and obviously the news has been coming out on the bright side. The other thing about the S&P is that the moving averages. Let's go take a look at those real quick so I can give you some insight there. The S&P moving averages, I'll give you right here. Hold on. 2785. So the 200 days at 2785. Where are we? We are at 3027 approximately. And so what is the difference there? The difference is 242 S&P points. That's getting a bit extended. So that's why I'm saying getting into this 2950, 3100 area could be an area where you'd want to consider hedging. How do you do the hedging? Many ways. Sell out some stock, buy some puts, do some collars where you sell calls and buy puts, do some covered writing, or maybe do some replacement trades where you get out of stock and replace it with long-term calls. All of those things are considered hedging in some circles, and they all have their unique use and risk. So if you have questions on that, you're not clear on it, you could always email me, and that's at optionprofessor@gmail.com. Okay, let's take a look here and go over a couple other things that I've been watching that have been improving, but certainly are still lagging. Let's look at the transportation average. And the transportation average was up 82. It did come off a little bit at the end of the day like the other markets. But as you can see here, the transportation average peaked out way back here in September, right? And that went way down, came back up, but never hit the high, came back down, came back up, didn't even take out that point yet. So again, still lagging. And if it rolls over to the downside under 10.5 and under 10,000, then a more significant correction in stocks could happen. Likewise, if we get above 11 and 11.5, this thing's off to the races. With that FedEx news, I don't know if that's going to happen, but we'll have to see. The Russell Index, 2,000 stocks, mostly domestic and also interest rate sensitive. They also had a pretty good rally on Friday, but let's take a look at the big picture here. And you can see that the Russell topped out here again, like the transports, 1750, 1742, came way down, came back up, couldn't take it out, came up again, didn't take it out much, and now we're back here again. Closes above 1600, could maybe give you a run, but there could be resistance right ahead at 1650. But again, it looks like it's trying to take off. And it's really above 1600 would be very constructive, 1650. And then if it starts breaking under 1550 and then 1500, then I think a correction is more likely. So again, keep an eye on these things. I think they're rather important. Next week, obviously, two things. Wednesday, you have got the Fed going to make a decision. And I think that'll cause some volatility. And then, of course, Friday, you've got the jobs report, because the jobs report comes out the first Friday of every month. And the first Friday of August is Friday. So what else do we have here? I'm going to go around the horn here. There are some sectors that seem to be moving, and some sectors seem to be back on a pause. The ones that are moving, the consumer discretionary, I'm going to be using the Vanguard ETF. There's many ETFs out here. I'm just using it for illustrative purposes only. So let's take a look at consumer discretionary. And you'll see that it has been moving strong. Now it's up near the high point, 187, 185, right? So it could have trouble up here, but it has been a place to be, as you can see, in the last month for sure. Money's been coming into the consumer discretionary. Okay. And let's take a look at another sector that seems to be going pretty good, which was the healthcare has been improving. So I'll give you a little insight into that. VHT. And that was up again Friday, 0.5%. And you can see there on the healthcare, and that's United Healthcare and, all the different healthcare companies. And there you go. It has stalled out a little bit here, but it has been improving a little bit. There's some concern about healthcare, so you have to be careful of that because, again, a lot of talk about changing the healthcare system. But the one I did want to show you is the financials. Those are the banks and things like that. Let's take a look at that one. 1 second here, and we'll give that up there. Okay. Now, again, this is your major banks, your JP Morgans, Wells Fargo's, Bank of America's, those kind of things. And they were up over 1%. So money's coming into the banks in anticipation because the consumer's out there with a job and spending his money. And that could lead to better, loan demand and things like that. So big drop to 54, nice rebound up to 70. Back down here, and now it's broke above 70. So obviously a very constructive area in the banks and the financials. And again, in the consumer discretionary, still looking pretty good as well. Now, what has had the bloom come off the rose? The oils, energy, oils having trouble getting through this 60 level on the crude. Years ago, if you had the Strait of Hormuz having this type of risk, you would have seen oil going through the roof. So I think it's evidence that the supplies are pretty adequate and that our demand on the foreign oil has backed off. So it's not as important what they do. But this is a chart that, unless it gets above 65 on this particular one and oil above 60, it's a situation where there's still questions in the oil market. Let's see what else is. Where were people hiding? They used to be hiding in real estate, REITs. That seems to have stopped as a more aggressive risk on has been going on. So here you go. You can see that it was up a little bit on Friday. Maybe the risk, maybe the risk on is going to abate after this Wednesday situation. And maybe this is the first tip of that, but it has been fading, lower highs there. And if you take out 85, obviously it could be sayonara. But again, the REITs were doing great, but then obviously when the risk on went on, the people backed away from it. The other one was utilities. And utilities was another place people were hiding, trying to make some money and yield at the same time. And like the REITs, they're hanging in there. They're up a bit. So again, if it's risk off next week after the Fed talks, these things may go back on their bicycle. But right now you can see it paused out and that kind of thing. All right. So what else do I like to show you here today? Let's look at a couple things in the news, like the gold market. And the gold market, we're gonna not the Barrick Mine gold, but I'm showing you the continued contract here. And gold's had a big run, but it is stalled. Now, it's up $3 today, but the high's been $14.54. Now, the moving average on this thing is in the 1300. So there is room for a pullback here in the gold. Again, there's your high point. So if we take out 1400, going down to where we broke out at 1350s in the cards, again, if we broke above 1450, 1500 could happen pretty fast as well. A lot of volume here, a lot of people coming into the ball game, so that's not bad. But if this volume is followed by a light volume sell-off, then that would be good, kind of bullish to me as well. So there you got on the gold, looks pretty good. And again, if you like the gold, you probably like the silver as well. And let's take a look at the silver. And the silver to gold ratio has been tightening. It was up way into the 90s, and I understand it's in the 80s now. So some people do think that that could be a play as well, the short gold by silver, as the differential is very high, and it could come in. There's your silver. Again, big move up, broke out above 16 and 1550. So on pullbacks, that could be where you'd get the pullback. And here's an example of the high volume run up, lower volume sell off, high volume run up, and let's see if we have a little low volume sell off, and then we could get another leg to the upside. Okay, what about gold stocks? GDX. Where are you, GDX? There you are. And GDX has had a good time of it. I brought it to your attention when it was in the 17s, right down here, 17, 18. I said it looked like it was turning. It's turning, 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 and then a pullback to 20. That's where the moving averages were. And then we broke above 22. That let the door open at 28. Okay. Up here, obviously it's extended. You got gap down here at 24. That's a possible pullback if gold pulls back. And so we'll have to see if that's in fact true. But GDX definitely seems like it's in an uptrend. And if gold is going to 1700, as some analysts have predicted, there should be a bright future on this GDX, possibly after a pullback. Okay, let's see what we else have for you. Oh, yes, some of the gold leasers are also very popular. One of them and there's many of them, but these are companies that are involved in the leasing of gold. Look into that. I think it's worthwhile to look into. Royal Gold is one of the best in class. It's gone from 70 up to as high as 120 in the 52-week range. It's at 117. So people who've gotten in this in the last 52 weeks from the low to the high have had a very nice run. Again, these guys are into leasing gold. Check out, there's a whole bunch of companies that do it. All right. What else is on the docket here? I'd like to look a little bit at the international picture. Alibaba. How we doing on Alibaba? 178. It seems to be turning a bit. Again, having trouble with the 190, but certainly 150 looks like a good line in the sand. So where are we on the moving averages on Alibaba? Let's take a look. Because if they get a deal with China, you got to figure this company would benefit. The moving averages are at 165 and 163. So you're a little bit above it. If you get pullbacks, there's your support zone in my view, 160, 150. You see 150 right there. So any pullbacks, that 150 number is the one you want to make sure it holds. And again, above 200 there, you can see that could be something to keep an eye on. And these guys are enormous. As you can see, their market cap is 462 billion. Definitely a big boy. All right, let's see what else is going on here. Crude oil. A lot of talk about crude. Let's see what the price looks like. I already gave you pretty much my overview. And let's take a look there. 60, right? Trouble. 50, support. Where are you? Right in the middle. Take out 60, 65, you're off to the races. And the oil stocks might do pretty good. You got Royal Dutch Shell, British Petroleum with very good dividends. And of course, they more than likely would benefit if we break out to the upside. Conversely, you break down, these will get hit further. And so right now you're in no man's land right in the middle. Okay, now let's look at interest rates because that's going to be this big story next week. 10-year note. Uh, 206 went up to about 210, and then it backed off a little bit. Now the key here is what's going to happen with this Fed. If they go a quarter of a point, and all these people that got into the bond market thinking they were going to get 50, they may cover their shorts. They may not cover their shorts. They may liquidate their longs. Remember, this is an inverse relationship. When interest rates are dropping, see how much they've dropped already? They've gone from 325 all the way down to under 2. That's a really big drop. And the Fed hasn't cut once. Now, if they only cut a quarter of a point, these people may have overestimated the weakness in the economy and how much cutting the Fed has in mind. If they've overestimated the Fed and underestimated the economy, they may reverse some of their positions. Now, when these yields, which is what 3.25% means and what 2% means, that's a drop in yield of 125 points. The Fed hasn't cut 1 point. Now, that might be overdoing it, and that may lead us to a bump to the 250 area, 245 area. Got to get above 215 first. Conversely, if they come out, cut a quarter and say, we're going to be cutting 6 more times, it could go, so there's guys out there saying interest rates are going back to 0. So you're at a very, very precarious time because people have flooded into this market and drove yields down, thinking 2 things. We got a weak economy coming, and the Fed's going to be cutting rates. If they're wrong, and that's not what's happening, don't forget earnings, consumer spending, 2/3 of the economy, looking good. They could be wrong, and that means they would take their profits on this position and go the other way, and the yields could rise. Conversely, if they're correct, the Fed is going to be very weak. These numbers are going to start dropping. Then, and this guy is correct, who's thinking over time, we could go down towards 0. Then obviously you'd break under 190 and then 175 is in the cards. So this week, a very big week for fixed income. And one of the things that fixed income is going big on is the high yield. This is HYG. a proxy for high yield. And as you can see, it's way up in the stratosphere again. Dropped dramatically. See, if we get a correction, this thing will drop. Got a correction in May, you went down. Got a correction in the fourth quarter last year. That's a big drop. And so here, and these are big volume sell-offs. Big volume sell-off. The run-ups here seem to be light volume. So that's dangerous, which means what? We break under 86, under 85 on this thing, and then the junk bond market might get into some trouble. Don't forget, junk bond means that the issuer has dodgy credit. That's why they call them high yield or junk bonds. Okay, so there gives you a little clue into that, and you have to be a little careful of the junk bonds way up here as well. Again, next week, Wednesday, Fed meeting, Fed decision, big time. I'll give you a little wrap up here. On the gold, very much looks like it's in a bull market. Could be vulnerable to a pullback. If we take out 1400, 1350 should be very good support. With regards to the stock market, very strong, all-time highs. If you find a weekly formation where there's a high surrounded by lower highs, then you might be looking at some exhaustion. And then, of course, if we break under 2950 and the VIX is breaking above 1517, then I think the stage could be set for a more serious correction. Interest rates, again, could break either way. Again, it does look like everyone's pretty invested in the bond market, so if they want to get out because the Fed talks a little bit less dovish, it could get a little messy in the bond market next week. And the high yield I just showed you could be vulnerable if, in fact, the stock market does have a dip and if, in fact, the Fed is less dovish. Okay, with regards to the dollar, it's in the same trading range, 96, 98. And if we can get underneath 96, 95, I'll buy into the dollar's weakening. If we don't, I'm not buying into anything. So basically, that's a little bit of an overview of some of the things. If you have any specific stocks that you have a question on, any specific strategies on the options for hedging, replacement trades, collars, whatever, simply shoot me an email, optionprofessor@gmail.com. Okay, until next week, I wish you all the best of trading and good luck, and keep your seatbelt on. Next week should be a wild ride. Have a good weekend, everybody. This is Jim Kinney. I'll talk to you down the road.